Ever wondered if you're, really making your credit cards work for you?
Right.
Or is it the other way around sometimes? Today, we're doing a deep dive into smart credit card use, specifically looking at it from a Canadian perspective. We've gone through a bunch of guides, research, pulled out what we think are the most crucial insights, maybe some surprising ones too. Our mission, like always, is basically to give you a shortcut to being genuinely well-informed. Practical advice, maybe a few aha moments along the way. Credit cards, they're powerful tools, right? Convenience, building credit, getting rewards. But we all know they can be a bit of a double-edged sword. Easy to slip into debt if you're not careful. So understanding how to use them wisely, well, that feels pretty key for a solid financial future.
Exactly. And what's, I think, often overlooked is just how foundational this stuff is. Here in Canada, pretty much every move you make with that card, it gets reported. We're talking Equifax, TransUnion, it directly shapes your credit score. So yeah, every little choice with that plastic, it genuinely matters. Impacts loans, renting an apartment, all sorts of things.
Okay, so let's pull back the curtain a bit then. Beyond just tapping the card, what are the absolute must-know basics about how these things actually work?
Well, at its core, when you use a credit card, you're borrowing money. Short-term loan from the bank, essentially. And here's the kicker. If you don't pay that money back the full amount by the due date on your statement, you get charged interest. And it's usually not cheap. Typical rates, you're looking at like 19.99%, maybe up to 24.99%, sometimes even higher.
Right. Which brings us straight to something that sounds simple but maybe isn't always followed, paying your full balance. Why is that so critical? What really happens if you just pay, say, the minimum?
It's critical because, well, it's the only way to completely avoid those interest charges we just talked about. When you pay off the entire statement balance by the due date, you get what's called a grace period. You've basically used the bank's money for free for a bit. But if you only pay the minimum or anything less than the full amount, you lose that grace period. Interest starts piling up right away on the remaining balance. A really simple, effective tip. Set up automatic payments for the full statement balance. That way, you just don't miss it, you don't pay interest. Simple.
Okay, that makes perfect sense for avoiding interest costs. But you mentioned credit scores earlier.
Yeah.
Even if someone pays in full every month, is there anything else they need to watch out for? I've heard about credit utilization.
Ah, yes. Credit utilization, that's a big one, and yeah, it affects your score even if you always pay on time. It's basically the percentage of your available credit that you're using at the time your statement is generated. The general rule of thumb, sort of the golden rule, is try to keep that usage below 30% of your total credit limit.
30%. Why that number specifically?
Well, the credit scoring models, like the ones used here in Canada, they see high utilization, like using 70 or 80% of your limit as a potential red flag. It suggests you might be relying too heavily on credit, maybe stretched thin financially, even if you do manage to pay the bill later. So below 30% looks much healthier to lenders.
Okay, can you maybe give us a quick example? Make it concrete.
Sure thing. Let's say you have a card with a $3,000 limit. To stay under that 30% guideline, you'd want the balance reported on your statement to be no more than $900.
Okay. So even if I spent, say, $2,000 that month, but paid it all off after the statement date, the high balance was still reported.
Exactly. The key is what the balance is when the statement closes. So, a little tip some people use. You can make payments before the statement date to lower the reported balance if you know you've spent a lot that month.
That's a good tip. Okay, so now choosing a card. There's just so many out there. Rewards, low interest, no fee. How does someone even start to figure out which one is right for them? It feels a bit overwhelming.
It totally can be. The key really is self-awareness. Understanding your own spending habits, your lifestyle, what you want the card for, because they really are designed for different people. You've got your cashback cards, great for everyday stuff. Groceries, gas, think Scotiabank Momentum, TD Cashback, Visa, cards like that, you get a percentage back.
Right, simple.
Then travel rewards cards. If you travel a fair bit, these make sense. Amex Cobalt is popular, RBC Avion. You earn points for flights, hotels,
Okay.
low interest cards. Now, if you think you might carry a balance sometimes, maybe you have a large purchase coming up, these are better, like the MBNA Trueline. Lower interest rate saves you money there.
Let's focus on rewards then.
Exactly. And finally, no fee cards. Maybe you're just starting out, building credit, or you just hate annual fees. Tangerine Money Back, BMO Cashback, they do the job without the fee. The really important thing is comparing them. Don't just grab the first offer you see. Use comparison sites like ratehub.ca or greedyrates.ca. They lay out the fees, rewards, interest rates side by side. It's super helpful.
Okay, that makes sense. Match the card to the habit. Vigilance seems to be a theme here. What about after you have the card? Checking statements, keeping track of things. How important is that?
Oh, absolutely essential. Non-negotiable, really. You need to review your statement every single month and not just like glance at the total owed. Look through the transactions.
Why? What are you looking for?
Two main things. First, fraud or errors. Spotting a charge you didn't make early means you can dispute it right away with the bank. Much easier to fix quickly. Second, it's just a fantastic way to track your own spending. See where the money is actually going. Helps you stick to a budget, maybe spot where you're, leaking cash unnecessarily.
Right, accountability. And what about the credit score itself? We know it's important, but how do people actually check it? Does it cost money?
Great question. And no, it doesn't have to cost anything these days. Monitoring your score regularly is crucial, helps you see the impact of your habits. In Canada, we've got excellent free services. Borrowell is one, Credit Karma Canada is another. They give you your score, often your report too, totally free. Plus, a lot of the big banks, RBC, CIBC, Scotiabank, others too, now include free credit score access right inside their online banking apps. Super convenient. Check your bank's app, it might already be there.
Okay, good to know there are free options. Now let's shift gears a bit and talk about some common mistakes or pitfalls. First one, that minimum payment number on the statement. It looks tempting, right? Why is only paying the minimum such a bad idea?
It is tempting, and that's the danger. It feels like you're meeting your obligation, but, well, the minimum is usually a really small percentage of your actual balance, maybe just 2%, 3%, sometimes 5%. What's really fascinating and kind of scary is how quickly the interest snowballs when you only pay that. Think about it. If you have, say, a $1,000 balance at 20% interest and you only make minimum payments, it could literally take you years to pay it off. Years.
Wow.
Yeah, and you'd end up paying hundreds, maybe even more than the original $1,000 just in interest charges. It basically turns a small debt into a long, expensive slog.
Okay, so avoid the minimum payment trap. Got it.
Yeah.
What about cash advances? Taking cash out using your credit card? I feel like I've heard bad things.
You probably have, and for good reason. Generally speaking, yes, cash advances are a no-go area if you can possibly avoid them.
Why so bad?
A couple of reasons. First, the interest rates are usually sky high, often even higher than the regular purchase rate, maybe over 24%. Second, and this is key, interest starts accruing immediately. There's zero grace period for cash advances. Day one, you're paying interest. And on top of all that, there's almost always a fee just for taking the advance in the first place, like a percentage or a flat fee. It's just a very, very expensive way to get cash, really only for absolute dire emergencies.
Okay, duly noted. Avoid cash advances. Let's switch to something more positive then. Rewards. Points. Cashback. People love them. What's the smart way to maximize those perks without, accidentally spending more just to get them?
Right, it's a balance. Maximizing rewards is great, but it has to be done responsibly. The core idea is simple. Use your rewards card for your regular budgeted expenses. Things you'd be buying anyway. Groceries, bills you can pay with a card, gas. And then this is the crucial part, pay off the entire balance by the due date, every time. That way, you earn all the points or cash back on spending you were already doing without paying a single dime in Inchinerd. The rewards are truly free then.
So it's about making your existing planned spending work a bit harder for you, not letting the tail wag the dog and increasing spending just to chase points.
Exactly. That's perfectly put. Keep an eye out for good sign-up bonuses. Sure, they can be valuable, but never overspend or buy things you don't need just to meet the spending requirement for a bonus. That completely defeats the purpose. It's about responsible earning.
Okay, let's unpack something else important. Having a plan for emergencies. Life happens, right? How do credit cards fit into an emergency plan? And what should you do if you do end up having to carry a balance because of something unexpected?
Yeah, that's a really practical point. It's actually quite smart to have a credit card, maybe one with a decent limit and ideally a lower interest rate if possible, set aside specifically for true emergencies. Think of it like a financial safety net for those unexpected big hits, car breaks down, urgent vet bill, whatever it might be.
Okay, so it's there if you need it. But what if you do need it and run up a balance?
Right. If that happens, your financial focus needs to shift immediately. Priority number one becomes paying that emergency balance down as quickly as possible. That means stopping all non-essential spending. Cut back wherever you can until that balance is cleared. And if you have balances on multiple cards, focus your extra payments on the card with the highest interest rate first. That's often called the debt avalanche method. It saves you the most money in the long run. It's about damage control and rapid repayment.
That's really clear, practical advice for those cuff situations. Okay, so we've covered a lot of ground here. If we were to boil it all down, what does this all mean for our listeners? Can we maybe recap the main do's and don'ts from this deep dive?
Absolutely. Let's try a quick summary. Think of these as your key takeaways. Do. Always, always aim to pay your full statement balance every month. Keep your credit utilization, that percentage of used credit, ideally below 30%. Do. Use rewards and cashback wisely on planned spending. Pick a card that actually matches your lifestyle and spending habits. And definitely monitor your statements and your credit score regularly.
Okay, those are the do's. What about the don'ts?
Right, the don'ts. Don't carry balances long term if you can possibly avoid it. The interest cost is just too high. Never max out your cards, it seriously hurts your score. Don't. Overspend just to chase rewards or hit a bonus. Don't apply for a whole bunch of new cards all at once. That can cause a temporary dip in your score. And obviously, don't ignore your payment due dates. Set reminders, use auto pay, whatever works.
That's a great checklist. Any final bits of practical advice, maybe especially for someone new to Canada trying to build credit, or just anyone feeling a bit lost?
Yeah, a couple things. If you are new to Canada or have damaged credit and you're finding it hard to get a regular credit card, look into a secured credit card. You provide a security deposit, usually equal to the credit limit, and it's a fantastic tool for building or rebuilding positive credit history. You use it like a normal card, pay it off, and it gets reported. Also, and this sounds basic, but it's crucial, never lend your credit card to anyone else. Not a friend, not a family member. You are legally on the hook for every single charge made on that card, period.
Good point.
And finally, if things do get overwhelming, if you're struggling with credit card debt and don't know where to turn, please know that help is available. Reputable nonprofit credit counseling agencies like Credit Canada offer confidential advice and can help you create a plan. Don't be afraid to reach out.
Wow. Okay, that really was a comprehensive deep dive into smart credit card use here in Canada. Super helpful. It feels like you, our listeners, now have a much clearer roadmap from just understanding the mechanics to using these tools strategically and avoiding those common traps.
Absolutely. I think the insights we talked about today, they're pretty fundamental for anyone wanting to build a strong financial foundation, making credit work for you, not against you.
So as you go about your day, maybe think about this. What's one thing from our chat today that really stood out to you? Could it change how you use your own cards? Or maybe even inspire you to share some of this with someone you know who might be struggling. Something to chew on. Thanks so much for joining us for this deep dive.